It is December, and 2022 has been a pretty epic year for me here on YouTube. The channel has continued to grow. I had the chance to travel to the Berkshire Hathaway annual meeting in Omaha for the first time this year, which is a pretty long way from down here in New Zealand to Omaha, Nebraska. I've got to meet some amazing people and have a bunch of really cool guests on the Investing with Tom podcast. People like Guy Spear, Brett Kelly, Monsoon Pabrai, and many, many others. And I thought this would be a pretty good time just to kind of sit back and reflect on some of the things that I've learned in 2022 that I think will make me a better investor over the very long term. I want to go through kind of a top 5 lessons for 2022, and I'd also be really interested to hear if there's anything that you've picked up throughout this year that you think has made you a better investor. Let me know that down in the comments section below. But without further ado, let's get straight into some of my highlights in terms of big lessons for me this year in 2022. Now, the first thing I want to cover, which has been a pretty big mental shift for me this year in 2022, is something that Guy Spear brought up on a podcast where I had him as a guest for an episode. And the question that was put to Guy was basically, have you ever made a really large bet in your portfolio, like a 50% position? And he turned that question into a pretty nice learning. And the main takeaway for me from what Guy said in response to that question is that anytime people talk about having a 10% or 20% or 50% position in their portfolio, you've really got to understand, what that means in the context of their broader financial situation. And for that reason, he much prefers if people talk in terms of percentage of their net worth. If you have a 20% stock position in your stock portfolio, but your portfolio is only like 10% of your net worth and a lot of it's outside of the stock market, that's really only like a 2% of your net worth position. And it's nowhere near as meaningful as when you say it's a 20% position. I think that to a certain extent is really exaggerating how big a bet that is for you personally. So these days, anytime that you hear me talk about a percentage allocation, I generally talk in terms of percentage of net worth. And if for whatever reason I think it makes more sense to talk about percentage of portfolio in response to a question or something, I try to make an effort to always specify that I'm talking about percentage of my stock portfolio. But I think percentage of net worth is just a lot more meaningful and a better way to communicate just how exposed you might be to a particular stock. Now, the second lesson for me this year, which I think I really already knew, but it kind of seared it in, was actually from a couple of different guests that I had on the Investing with Tom podcast through this year. Firstly, I had Mitch and Cass Dole, who are a couple out of Australia who essentially are full-time investors at this point in their early 30s. And I also had Sam and Chris from the Earn More, Spend Less and Invest the Rest YouTube channel. They are both examples of couples that are completely on the same page when it comes to their investments. It allows them to have good conversations about moves they might be making financially. It allows them to take, big bets when they've got strong convictions around a particular idea because they're both on the same page. And I think overall it just makes the situation a whole lot less stressful. A lot of people in relationships tend to have like one person in the couple kind of leading the whole financial situation. And to have two people completely on the same page, I think is fantastic. In terms of my own situation in this area, I think we were pretty good with being on the same page already, but it's become even more important. My partner and I have purchased our first home this year. We've also merged finances, and it's cool to see other couples working really well together in their investments also. Now, the third lesson that's come through this year is actually from Matthew Peterson of Peterson Capital Management, and that is the idea that value investors can actually use options intelligently around their core kind of value investing ideas and running a concentrated, sort of well-structured portfolio. Now, options was something that I really never had messed with. I viewed them as very speculative. They're essentially very leveraged, bets on a particular stock, often with some sort of very restrictive time frame around them. And typically when people talk about options, they're talking about things like buying call options, which essentially means if the stock goes up to a certain price, you can make a lot of money, at least in percentage return terms. And if the stock doesn't meet a target price, you lose everything. And that was the lens that I'd heard most people talk about options. But Matt Peterson kind of flips that the other way around and explains how with a value investing strategy, you can actually use options intelligently to kind of lower your cost basis on the way into a stock and potentially capture a little more on the upside when you exit out of a stock. Matt Peterson kind of explains his strategy of selling put options when he wants to get into a company and selling call options when he wants to get out of a company is kind of like acting as the casino. You know, a lot of people go to the casino, bet a bunch of money and are super speculative and gambly, and we always know that the house has the advantage. So Matt Peterson kind of says, why not be the house when you have that option and be the one selling the options as opposed to buying the options. And he also states that if you have sort of a view on an underlying company's intrinsic value, that can also offer a great advantage when it comes to wrapping options kind of around a core value investing portfolio, because option prices and option premiums are calculated in a way that has absolutely nothing to do with the underlying intrinsic value of a company. And if you find a company with stable business results and that you can calculate intrinsic value for, with some confidence, you have a very volatile stock and option premiums very high, that can create some interesting opportunities for long-term investors. Another lesson that was really enforced for me in 2022, again from some of my conversations with Guy Spear on the podcast, was that a few good ideas can really move the needle. And to dive a little further into that, if you buy a great business for the long term and sell too early, that can be an absolutely enormous mistake. Guy was kind enough to share in public for the first time his investment in LH, or Laboratory Corporations of America, which was a stock that he invested in the early 2000s. He followed Lou Simpson, one of Warren Buffett's investment managers, into that particular situation. LH had just gone through a merger. They had a technical default on their debt, but looking through the facts, there wasn't any real risk of the business actually going bankrupt. But Guy Spear kind of got caught up in a big 75% roughly quotational loss in a pretty short kind of period of time on LH. The pressure kind of became too much for him and he ended up selling that stock. Now, if Guy Spear had just held on to that position from his initial purchase price, it would have been much more than a 20x return looking back at it today. And if he had even added to the position at the low prices that LH got down to, it would have been well more than a 100x return. Guy unfortunately has a similar story with CRISIL, which is kind of an Indian equivalent of a rating agency like Moody's or S&P, where Guy kind of says that one of the worst things he ever did was woke up one day and felt that he'd made enough money from CRISIL, and he sold it too early. It's continued to go up a lot, and I believe that also would have been pretty close to a 100 bagger for Guy Spear if he just continued to hold on to that great business. But luckily, Guy does have a few examples of where he has managed to hold on with stocks like MasterCard, BYD, and Berkshire Hathaway, which he's owned since the late 90s as well. So you don't have to be super active with buying and selling all the time. And in fact, if you've bought a really good business and your analysis is correct and they've got a long runway for growth, just holding on to those companies can be an exceptional decision to just keep making over and over again. And number 5, again, an idea that was really just reinforced this year was to look for no-brainers. This is one that's come from a recent conversation again on the podcast with Jake Taylor of Farnham Street Investments, also the Value After Hours podcast, author of the Rebel Allocator and founder of Journalytic, an investment kind of journaling software. That podcast with Jake is probably live by the time you're seeing this video, so definitely check that out if you're interested. But Jake is always on the hunt for no-brainers. And that was a lesson that he definitely reinforced in the conversation I had with him. He brought up the example of investing in oil in 2020, where there was just massive kind of decreases in demand for oil in the short term. The oil price crashed. There was really just no storage capacity for oil left. People were filling their swimming pools with the stuff. And oil futures even went negative at one point. And although the earnings in the short term for a lot of oil companies got absolutely crushed, when you looked at the value at which these oil stocks were trading versus just the assets that they had in terms of oil in the ground, they looked exceptionally cheap throughout that period of time. So it's a lesson we've had from lots of different investors, from Guy Spear, Monish Babrai, and Jake Taylor in this case, that you really shouldn't need to fire up Excel particularly often when you're valuing a particular company. It should be super obvious, and you should be able to do the maths in your head, and it should smack you over the head head with a 2x4 that this thing is really, really cheap. Now, one kind of bonus thing I just want to bring up in this video that I was really reminded of in 2022 is just that the value investing community in general is awesome. It's a great community to be a part of. I think the long time kind of history of Warren Buffett and Charlie Munger just getting up and openly sharing their ideas on how they go about investing has ingrained a similar culture in a lot of different value investors. You know, people are always really willing to share their ideas in terms of how they go about investing, not always necessarily what stocks they're buying and that type of stuff, which is completely fine, but sharing the lessons people are more than happy to do. And everyone is just on a similar wavelength. You know, going to Berkshire Hathaway this year and meeting the likes of Monish and Guy and Lilu and going with Brandon and Hamish, it was a great experience, a lot of fun, and everyone's kind of just happy to talk to one another like they're all regular human beings. No one is behaving like they're far better than anyone else or anything like that, and that's very cool to see. So a big thank you to all the people I just mentioned, as well as you, the ones that are always watching these videos week to week, the people on the Punch Card Investing channel that come to our weekly live streams, and the crew over there that I get to talk to all the time. It's always very cool to do that. And I'm really excited to keep those conversations going and keep the YouTube channel growing into 2023. So those are some of my kind of highlights in terms of big lessons for 2022. I do hope you enjoyed the video. Like I said, let me know down in the comments section below what some of your big lessons were for the year. But that's it from me for this one, and I'll see you in the next video. Cheers.